Imagine walking onto a car lot today, excited to drive home in a shiny new ride. The dealer smiles, hands you a pen, and says, "Congratulations, you're approved." But here's the twist. You just signed for a subprime auto loan. What does that really mean? And is it a smart choice or a financial trap waiting to snap shut? By the end of this video, you'll know exactly whether a subprime auto loan is worth taking, how it really works, behind the scenes, and the secrets lenders never tell you. Stick around, because one decision here could save you thousands of dollars or bury you in debt. Number 1. What is a subprime auto loan? A subprime auto loan is simply a car loan designed for people with low credit scores, usually below 620. If you have missed payments, defaulted on a loan, or carry high credit card balances, you may be considered subprime. Lenders see you as a higher risk. And in return for taking that risk, they charge you a higher interest rate. For example, while someone with good credit might get a car loan at 6%, a subprime borrower could face 18% or even 25%. That means the same car can cost thousands more just because of your credit score. Number 2. Why do people take subprime loans? Let's be real. If your credit isn't great, most banks and credit unions will reject your application. But a subprime lender says yes. This can feel like a lifeline when you need a car to get to work or take care of your family. Picture this. Two people want the same $20,000 car. One has good credit and pays $350 per month. The other has bad credit and pays $520 per month for the exact same car. Over a 5-year loan, that's more than $10,000 extra, all for the privilege of having poor credit. Number 3. How lenders make subprime loans appealing. Subprime lenders are smart. They don't just talk about the interest rate. They focus on low monthly payments. A dealer might stretch your loan to 7 years so your payment looks affordable. But here's the catch. You could end up owing more on your car than it's worth. That's called being upside down. Imagine you buy a used car for $18,000. After 2 years, it's worth $12,000. But you still owe $16,000. If you need to sell or trade it in, you're stuck. Number 4. The hidden risks. Subprime loans often come with extra fees. Some have GPS trackers or starter interrupters installed in the car. Yes, you heard that right. If you miss a payment, the lender could literally prevent your car from starting until you pay up. Others add insurance requirements, service contracts, or hidden charges. And repossession is a real threat. In fact, research shows that subprime borrowers are more than twice as likely to have their car repossessed compared to prime borrowers. Number 5. When might a subprime loan make sense? There are situations where it could work. If you truly need a car to keep your job and you've explored every other option, a subprime loan might be your bridge. But the key is not to treat it as permanent. Think of it as a short-term solution. Pay on time for 12 to 18 months. Then refinance into a better loan once your credit improves. For example, Maria took a subprime loan at 19%. After 1 year of consistent payments, her credit score went up and she refinanced to 8%. That cut her monthly bill by $200. Number 6. Alternatives to subprime loans. Before you say yes, ask yourself, what are my other options? You could buy a cheaper used car with cash. Even if it's not flashy, you avoid interest altogether. You could ask a family member with good credit to co-sign. This lowers your rate, but comes with risk to them if you don't pay. Or you could join a local credit union. Credit unions are often more flexible and may approve you with fairer rates compared to big banks. Example, Jake thought his only option was a 22% dealer loan. Then he checked his credit union. They approved him at 12%. Still high, but it saved him thousands. Number 7. How to improve your chances without taking subprime. The truth is, a credit score can change faster than most people think. Paying down a credit card balance, making on-time payments for 6 months, or disputing errors on your credit report could lift your score enough to qualify for a regular loan. Imagine waiting just 6 months. Instead of paying $500 per month, you might pay $350. That's like giving yourself a $150 raise every month. Number 8. What to look out for in a subprime contract. If you must take one, read the fine print carefully. Watch for prepayment penalties. Some lenders charge You extra if you pay off early or refinance. Look at add-ons like gap insurance, extended warranties, and service contracts. Dealers love to sneak these in. And always compare the out-the-door cost of financing, not just the monthly payment. Number 9. The emotional side of subprime loans. Let's be honest, car buying is emotional. You see the shiny paint, smell the new interior, and imagine yourself driving away. But here's the truth. That excitement fades fast when you're stressed about making a huge payment every month. Ask yourself, do I want this car, or do I want financial peace of mind? Sometimes choosing a smaller, older car is the smartest play, because freedom from debt feels way better than leather seats. Number 10. The bottom line. A subprime auto loan is not automatically evil, but it is dangerous if you walk in blind. If you understand the risks, use it as a temporary solution, and make a plan to refinance, it can serve as a stepping stone. But if you sign without thinking, it can trap you in years of debt. So before you grab those keys, remember, the real cost of a car is not just the sticker price. It's the financing. Number 11. Subprime loans and car depreciation. Cars lose value quickly, especially in the first few years. When you combine a high-interest loan with a fast-depreciating asset, the math gets ugly. For example, a car bought for $25,000 may be worth only $15,000 after 3 years. But with a subprime loan, you could still owe $20,000. That means if your car gets totaled or stolen, insurance may not cover the full balance. You'll be stuck paying for a car you no longer even have. Number 12. The role of dealers in pushing subprime loans. Many car dealers make more money from financing than from selling the actual car. That means they have a strong incentive to steer buyers with shaky credit towards subprime lenders. Sometimes they even mark up the interest rate you qualify for and pocket the difference. For instance, if a lender approves you at 15%, the dealer may quietly increase it to 19% and keep the spread. This practice is common, but most buyers never realize it. Number 13. Subprime loans and repossession cycles. For some lenders, repossession is not a failure. It's part of their business model. They finance high-risk borrowers, repossess the car when payments stop, and then resell that same vehicle to another borrower. This cycle can happen multiple times with the same car. It's profitable for the lender, but devastating for the borrower. Number 14. Subprime auto loans and your credit score. Taking a subprime loan doesn't just cost you more money. It also impacts your credit profile differently, depending on how you manage it. On-time payments can boost your score over time, but one missed payment can send your score spiraling down even further. And repossession can drag your credit down by 100 points or more, making future borrowing even harder. Number 15. The psychology of "I need it now." Many borrowers fall into subprime loans because of urgency. Their car breaks down, and they need transportation right away. This urgency clouds judgment and leads to poor financial choices. But renting a car for a few weeks, carpooling, or using public transit could buy you enough time to improve your credit and avoid a costly subprime contract. A few months of patience can save you years of debt. Number 16. Subprime loans and refinancing traps. Lenders may promise you the ability to refinance later, but not all keep that promise. Some design loans with conditions that make refinancing difficult. For example, if your loan balance is much higher than the car's value, other lenders won't touch it. That leaves you stuck until you pay down enough of the balance to even qualify. This is why it's critical to understand the refinance path before you sign. Number 17. Subprime loans and car insurance. Many subprime contracts require borrowers to carry full coverage insurance, no matter the car's age or value. This can add hundreds of dollars to your monthly costs. Imagine paying $500 for the loan and another $250 for insurance every month. That's $750 for a car worth less than $10,000. The car becomes a burden instead of a blessing. Number 18. The effect on your overall financial health. A subprime auto loan doesn't exist in isolation. It impacts your entire financial picture. High monthly payments limit your ability to save, invest, or pay off other debts. It may also cause you to rely more on credit cards, which can spiral into additional financial stress. One bad car loan can ripple across your whole financial life. At the end of the day, a subprime auto loan can either be a bridge to better credit or a financial pitfall you'll regret. The choice depends on your plan, your patience, and your priorities. Now let me ask you, if you had to choose today, would you take a subprime loan to drive the car you want, or would you wait and rebuild your credit first?